One of the main questions I get asked is how does Profit First implementation work with the different company structures in Australia? I'm going to start today with the sole trader. Sole trader being that whatever happens, the individual and the business is treated as one. When it comes to Profit First implementation, we do not want to do this. We want to treat it just like any other company entity, company trust, business structure entity, where the owner is separate from the business. Therefore, the owner's pay and the profit are treated just like you would with a company or a trust. We get a lot of FAQs from sole traders where they ask, well, if I am a sole trader, do I have to have a separate owner's pay account, or can I just transfer, a dollar figure to myself each week? We highly recommend that the owner's pay account is implemented for the sole trader. Reason being is it's based on a percentage, and then from that, the sole trader can take a regular income or wage from that amount. That means that in the lower periods, there is a buffer in the account to maintain that wage, and in the best months, it creates that buffer. So that's the first thing. The second thing is that the profit and account and owner's pay should not be combined. Reason being is that the profit has a very different function to the owner's pay, and that the profit is used for either fund money for the business owner, the vault, so creating that buffer within a business for the 3 to 6 months, as well as the debt buster. And so regardless of structure, we do not want to combine those. We want to keep them as separate. The other thing is that with the percentages, I get the question a lot where it's like, okay, so I'm a sole trader. What is the tax percentage that I should be using? With a sole trader, what I recommend here is to look at what is the profit within the business. And if you're not an accountant yourself, be sure to include the accountant or ask one of the other Profit First professionals who is an accountant to help you workshop what this looks like. I'll also put an example with this video so that you can see what I'm referring to. Basically, if they have to pay GST, as we all know, GST comes off on top. So the gross income less the GST leaves us with the real revenue. From the real revenue, the tax percentage is then worked out based on what their profit is or going to be. A lot of the times, the 15% tax that is in the book is sufficient for the sole traders that are at the startup sort of level, or, whilst they may be turning over a fair amount, their real revenue and therefore their profit is actually quite small still. So be sure to look at that. The 15% tax, if we go for that percentage at this point in time, comes off the real revenue. So, for example, if their gross income is $500,000, but their real revenue is only $150,000, and out of that, their profit's $18,200, $20,000 even. When you're looking at the tax brackets, there's actually no tax on that $18,200. And then there will only be a small portion of tax based on the remaining portion to get them to that $20,000 mark. And so a 15% tax allocation may actually be excessive. So looking at that, you really need to modify that. That said, if they've got a really big sort of profit where their gross income and real revenue and profit are therefore a lot higher, then we're wanting to increase that percentage. But again, it's looking at and understanding what the end profit or what is left over in the business helps to determine that percentage. And so for sole traders, I do recommend starting as a general rule with the 15%, but it can increase to 20, 25 and up from there depending on where they're at. If you have any questions about a sole trader, or there's something that's not quite clear with a client that you're working on, reach out to us via email and we'll be happy to help. Have a great day.